Well, guys, I got some breaking news, and it looks like somebody is starting to drop off the Magnificent Seven among Wall Street. And we got some Fed talk, we got some economics talk, obviously a lot going on there. Obviously, somebody dropping out of the Magnificent Seven, apparently, and a lot more. So make sure you like the video if you like getting the truth off the hype, because that is exactly what you're going to get today, guys. And we got to discuss this, right? Wall Street's at it again. Let's see what's true, what's not true in regards to all this sort of stuff. And of course, we'll talk about exactly what stock fell out of the Magnificent Seven, why, what my opinion is on that, and everything else. And remember, if you want to work directly with me before the price goes up, and it won't ever be this cheap again, check out the pinned comment down there for the Cyber Week sale for my group. Lock in that price right now. Otherwise, the price will go up there at the beginning of the year. If you lock it in right now, you get to keep it for life, guys. I've never raised it on a single member, and I don't plan on doing that either. So check it out. It's the pinned comment down there. We'll talk more about everything you get at the end. But let's get into this and see exactly what Wall Street's saying.
Art Hogan, Chief Market Strategist, B. Riley Wealth Management, is with me now. Good morning, Art. I hope you had a nice Thanksgiving holiday. How are you feeling about the economy in particular? Because that will drive what the Fed does next.
Yeah, really well. We're finally going to start to get some inline economic data, some not dated economic data this week. And I don't know that we're going to get anything that sort of tips the apple cart into a place such that the Fed doesn't see their way clear to cut rates. Now, it's not going to be a unanimous decision at the next meeting, but I certainly think there's enough support behind the fact that, while the PCE at the core level likely won't be close to target and be closer to 3%, I think the concern over the softening of the labor market hasn't changed much. And I think that really drove the decision back in September and clearly will drive the decision again in December. So whether or not we see a hotter PCE, which isn't likely, we know about 80% of the components of the core PCE once we get a CPI and a PPI. So that's pretty well known. I think that, we may have a split decision, maybe a 7-5 vote, but I think the Fed cuts again in December, agnostic to what we see this week and some of the other data, things like the ISM manufacturing certainly comes out later in the week and some other prints that are now real time. We'll get a new University of Michigan consumer sentiment survey, but I think the Fed's got enough evidence in front of them that we're just not creating enough jobs on a monthly basis to keep unemployment in check.
So,
yep, can't argue there so far. Agree with what he said. I think it's very obvious they're going to cut rates one more time, and we'll see what happens from there. Obviously, there could always be surprise data that pops up. But I'm not going down any of the rabbit holes of who's, manipulating data, blah, blah, blah. I've heard that before. It's been going on for pretty much more than a decade now. So that's nothing new in regards to people saying that. It also tends to kind of skew depending upon which side of the owl you're on as well. But in regards to this, yeah, I think the Fed definitely cuts in December there. They want to move more to that neutral, and that's basically how you get there is by cutting the rates a few more times.
They'll be more concerned about the jobs picture, even if whatever comes in with this PCE print on Friday. Also, it's such a lagging print. I mean, unless it's off the charts and makes them scratch their head, they're probably still going to go with the cut. When we think about what goes on in the new year, we were talking about quantitative tightening ending now. It's essentially now quantitative easing, and that often gives a little boost to the market. Do you expect the Fed will continue to cut in the new year? Should they cut?
Yeah, I think largely dependent on what the economy looks like and the path of economic activity, especially if we continue to see weakness. If we don't see the labor market firming up to a point where unemployment stops rising, right? We've gone from a low of 3.8% up to 4.4% in unemployment. That likely continues to tick higher. Now, that's not alarming in and of itself, but directionally, it certainly is a concern for the Fed. And one of their mandates that they're likely to defend a whole lot more than the inflation mandate, because part of that inflation picture is coming through core imported goods, which we know is a one-time event, will anniversary over the course of the next 6 to 12 months. So I think the Fed likely has a window to cut it.
Yeah, and expect everybody on social media to miss that and then turn it into a big deal. But hey, doesn't make for a good story and a good social media post and a good scare tactic if you don't, if you use actual facts and look out beyond what exactly the headline is at the time. So.
At least 2 more times next year. That's what they penciled in their last summary of economic projections. That's probably close to where they think neutral is at this point in time, and that's where they'd like to get. They'd like to get from being a bit too restrictive to being closer to neutral. They never know where neutral is, but I assume around the table 2 more rate cuts at some point next year fills in that blank.
Yeah, can't argue there. That's pretty much what I have on my bingo card as well. Of course, it can change. Of course, it really doesn't matter what I think. So that's kind of the bigger thing there. But yeah, absolutely. They're going to cut a couple times next year, try to get back to that neutral position, and then wait and see what happens from there in regard, and basically play the game and try to. The Fed never seems to be ahead. At least this particular Fed never seems to be ahead, but not be too far behind in regards to what's going on.
Just looking at some of the price targets for 2026. I mean, Deutsche Bank is on the high end, of course, with their 8,000. But most of the brokerages and banks or whatever, I see 7,100 from Bank of America, HSBC 7,500, Morgan Stanley 7,800. What do you say between now and the end of next year?
Well, I'll tell you this. We just wrapped up a great third quarter earnings reporting season. What was important about that was we had the third quarter in a row of double-digit earnings gains. Estimates for the fourth quarter and...
Love the way this guy's talking about earnings gains. Not about hype, not about hope. Talking about actual earnings. What are we seeing in terms of performance? Bottom line profits. That right there is what matters in the end. Not all this other stuff that everybody always wants to talk about. So starting off, wow. Let's see how it goes. But right now, I'm right on target with this guy.
For next year went up. So the estimates for next year for the S&P 500 are for low double-digit earnings gains. I think if you were to put a normalized multiple on that, we could certainly see, a 7,700 S&P 500 by the end of next year, just using the fundamental math. Now, it's always a tricky prospect to make that, call in December and look out 12 or 13 months. But I certainly think if estimates stay in place or get better for earnings for the S&P 500, and we use the same multiple that we've ended the year at for the last 5 years, it certainly gets you around that 7,700. Now, all of this is going to be dependent on, something not blowing up, the economy slowing much more precipitously, the Fed having to actually come to the rescue instead of just getting to neutral. But as we look out right now, I think the fundamentals are more good than bad.
Wow. Yeah, I totally agree with this guy so far. It's rare that I'm on the same page all the way around with a Wall Streeter. I love the fact that he kind of was like, hey, it's really hard to look out a year and really tell what it happens. In regards to where I think the S&P is going to end up, I don't freaking care. I couldn't care less. I don't own the S&P. Now, if you own the S&P, it matters. If you own individual stocks, doesn't matter one bit. That's why a lot of these charts and graphs about, the market's going to do this and the market does this during a bear market, or when the inverted yield curve flips or Sigma Rizzler lines all that stuff's all based on what the market does. I've never owned the market. I haven't for a long, 20 plus years. I've owned individual stocks, which they have sometimes moved with the market. A lot of times, though, they have moved wildly different than what the market did. Direction may be the same, but the market may be up 20%, and you got like Palantir, up on a 20x. The market didn't 20x, but Palantir sure as heck did. And obviously, you've had stocks go down despite the fact the market being up big this year as well. So I don't care what the indexes do. I've never been into predicting that. I think predicting anything out in terms of that's traders' games, traders, whatever you want to call it. Trader games is essentially what it is. But this guy at least was like, well, hey, if I want to apply a multiple to it, I take the average of the past 5 years, apply that multiple to what earnings growth is supposed to be or projected to be, and he comes up with a very reasonable valuation. I love that. That's exactly how it's done. That's exactly how a prudent investor, if you're going to project out, like let's say you owned a S&P and you wanted to project out that way, that is a great way to do it. That is essentially how you end up with a very reasonable price target. Not all this other, the AI trade is this and all this other goofy crap that people put out there. Let me put it in my spreadsheet, my model, and, model this sort of stuff out. Guys, it's as simple as that in the end in terms of wanting to get a reasonable valuation for what's going on. Now, of course, that's assuming, like he said, things don't blow up. We don't have a big downturn of some sort. There isn't some, massive event that creates, massive chaos, all of which are possible. And that's okay. That's why these predictions are somewhat useless in the end, because I'm not trying to guess all the chaos. It's impossible to guess all the chaos. I simply need to plan and know exactly what I'm going to do if my stocks run up, if my stocks come down, whatever the case is. I have a plan for it. I already know what I own. I already know what I want to buy. I already know what prices I want to buy it at. And I simply execute and move on. That's what a prudent investor does. But so far, for a Wall Street guy, we'll see if he blows it here. But for a Wall Street guy, so far it's not too bad.
I also think that, look, the obvious is that no one has a lower price target. They all think that there's room to the upside, at least, whether it's 2%, 10%, whatever it is. Look what happened with Bitcoin, which is down 20% in a month. And now people are saying it's going to be back to new highs by the end of even January. So I'll put that aside for the moment. What about just the seasonality of December and Santa Claus rally? Are you anticipating that we might get that?
Yeah, some of the seasonals haven't played out very well. We had a very calm September and October. November was rocky in the front end, but it hit a low on the 20th and bounced nicely. That piece played well into seasonality. Seasonality around December is very good, and on average over the going back 50 or 100 years, it's one of the better months and typically up 1.3% or thereabouts on average. So I think the seasonality and the fact that we did the washout in the first part of November sort of helps that concept around a Santa Claus rally. Also helping that is the fundamental fact that we're going to start to get economic data, and we will likely have another rate cut to throw into the mix on top of the fact that earnings growth for the third quarter was certainly better than expected, significantly better than expected, and earnings estimates for the fourth quarter have gone significantly higher. So I think we can trade higher into the end of the year. And that doesn't mean we can't.
Yeah, I won't disagree there with the general sentiment, but understand, guys, I don't care about a Santa Claus rally because it means nothing to my individual stocks. We've seen a lot of great stocks. Look at, obviously, NVIDIA had great, incredible earnings, great guidance, incredible guidance, and it's traded down. Other stocks have ran big for no good reason after okay earnings. Like, that is just part of the market cycle. So maybe the market moves up overall, but it doesn't necessarily mean your individual stocks are going to move up. And I've never banked on rallies and things of that nature, because trying to guess these type things and trade around it and all that sort of stuff is a fool's errand, because you end up missing those big days, right? Everybody guessing, after the or right before the elections, right? All the chaos and everything else that was going to happen, last year around that time frame, August, September, October, everybody was guessing it's going to be down. Every chart and graph said, oh, coming into election, it's always down. Traditionally, just these are down months anyways. And obviously the market just rocketed during that time, and you missed out on a fortune playing those games. So in terms of Santa Claus rally, I don't care. I'll see what my individual stocks do. If they do, great. Some of them are extremely overvalued, and I expect them to trade down because they're so overvalued. And I expect some of my undervalued plays to obviously pick up steam. But again, is that going to happen? I don't know. I plan for both, and I kind of move on.
Still see some of the washout that we're seeing on the more speculative edges of the market. So some of the hyper speculative names, and certainly cryptocurrencies kind of falling into that bucket, and tends to be very high beta when the ultra speculative edges of the market sell off. I think it's okay to continue to see that washout, but I think in general, when we look at the S&P 500 on balance, we're probably going to see a drift higher, certainly at the end of the year, and close at new highs.
Do you turn to some of the Mag 7 names as your long-term holds? I know they've been volatile, but some of them are just, sort of good old names that we know. What do you say about some of those tech names?
Yeah, if you take the Mag 6, take Tesla and you make that its own use case, and take the Mag 6 and say, how are we trading in terms of...
Ooh, there it is right there. And it gets a little deeper here in just a second, I believe. Tesla out of the Mag 7 there. We'll talk about it here in just a second. Let's let him finish his point.
Valuation. So the average PE sits at about 32, which is very fair for companies that have an average earnings growth rate between 50 and 60%, throwing off gross margins north of 65%. So in terms of valuation on the AI darlings or the Mag 6, I would certainly say they look very good. And I think that what happens inside of that is you get this rotation. At the beginning of the year, nobody wanted Apple, and now Apple has kind of declared their AI strategy with partnerships through Alphabet, and certainly they'll announce another partnership for international AI.
How about nobody wanted Google at the beginning of the year, and it's almost doubled up from that time frame? Maybe doubled up now. I'm not sure. I need to check that. But yeah, how about that one? That's an even larger swing in regards to the AI play and all that sort of stuff like that. Shows you how much that stuff is just simply noise. Nothing changed with Google. Just silliness.
It makes Apple intelligence that much stronger. I think Alphabet has certainly taken over the lead from the early leaders like Microsoft in the AI race. So internally, you're going to see some rotation, but I certainly think that as a group, they continue to look to be the most attractively valued in the last 2.5 years since ChatGPT rolled out, and continue to throw off significant revenues and earnings.
Yeah, I mean, in regards to a lot of folks saying that, the AI bubbles, like the tech bubble and all that sort of stuff, I don't think people understand that, the big names that were, rocketing to the moon and, carrying the entire weight, they were not trading at, at an average of 30 in terms of the multiple. They were significantly higher. And there was a lot more. There's some trash out there. Do not get me wrong, guys. There's a lot of trash out there right now. But you have no idea as to how many hundreds of companies of trash that were out there in the .com bubble during that time, going to the moon every day. I mean, it was chaos for years, 2-3 years that went on. So, in regards to this AI bubble, that's one of the reasons why I don't really believe it's a bubble. And if it is, and we happen to get an incredible discount on these stocks again, you're going to make so much easy money, just like Meta at 80s, back in 2022, just stupid. That really, when your valuations are very reasonable right now, if you get any sort of a bubble popping type of event, if it drags down, the big dogs, your, Apples, Amazons, all those sort of things, wow, you're trading at, anywhere from a 25 to a 35 or whatever the case is. You're going to end up in that meta territory, meta 2022 territory really, really fast. It doesn't take a lot to do that there. Obviously, that was just ridiculous. I don't think we'll get that low. But the point being, it's going to be very, very easy money with companies that are just continuing to grow revenues. And if they're not growing revenues, kind of like Apple's kind of stagnant in terms of on the revenue side, they're absolutely spitting off more and more EPS. Obviously, margins are getting better across the board. I mean, these companies are absolutely destroying it on every single level. At least the Magnificent Six, like he said. Obviously, we'll talk about Tesla here in just a second. But that Mag 6, I can't argue with that. It definitely makes sense to me.
AI it is. My goodness, the Mag 6. Okay, no Tesla. I got it. Art Hogan, great to see you on this Monday. Thanks for kicking off this busy week. Appreciate it. Chief Market Strategist, B. Riley Wealth Management. Always great.
All right, let's go ahead and stop the video right there. We spoke about the play with the Magnificent Six. And if you want to talk about Tesla here separately, here's where I'm seeing, and this is the second or third time I've heard a Wall Streeter basically not calling it Magnificent Seven, but basically saying these six are over here, Tesla's over here. I know there's going to be some disagreement about that, but we've had for really since 2022, those lows, everybody else has destroyed earnings. Massive revenue growth, massive EPS growth, just crushing it. And Tesla's been the only laggard. They have stagnated during that time. Now, it doesn't mean Tesla can't catch up. It doesn't mean they don't have a lot of things working in the background. But when you're looking at, and I'm not saying I'm personally would remove them from the Magnificent Seven. I think having all those sort of names, just like I thought Fang was stupid, I think Magnificent Seven is stupid, Magnificent Six, whatever the case is. But I can't argue with, if we're looking at those seven stocks, Tesla by far and away has been the laggard. They have by far and away underperformed everybody else. They have been far and away lost a lot of the lead that they had. They have not performed at all. Now, obviously, I think Elon coming in full time again and stopping the side quest and essentially getting focused back on Tesla is going to help get them back up there. But to say that they perform similarly or the same, or this guy's just hating on Tesla because he doesn't like Tesla, no, he's talking about performance, and there's no argument. I can look at the Magnificent Seven down the list. Tesla by far and away has been the laggard, and during a time when the rest of tech has boomed. Right in, Tesla's wheelhouse. Everybody's saying Tesla's more than a car company. Well, guess what? The entire, the rest of the Magnificent Seven has boomed in that space, whereas Tesla has stagnated and fallen in that space and has not made the type of progress that we obviously expected from Tesla, 3 or 4 years ago, before all this chaos and all the mess started with chaos. They've not executed, is the bottom line. These other companies have executed on an incredibly high level. Now, can Tesla get back to it? Can Tesla execute on an incredibly high level as well? Yes, absolutely they can, because he's done it in the past. Tesla has done it in the past. 2018, 19, 20, 21 were incredible execution years. I'm not talking about hype and all the other stuff. Screw stock price for a second here. Get that out of your head. I'm talking about looking at the business, looking at the revenue growth, looking at the EPS growth, looking at margins improving. All those sort of things were clicking on all cylinders and looking like the Magnificent Six, Seven, whatever, the other, you guys know. Anyways, looking like everything else, big tech has today. That's what Tesla looked like during that time frame. However, the past 3 years, they have looked not like that at all. Basically, flat revenues, margins going down and going down significantly, EPS declining, all the metrics that you want to see growing at the clips that, large tech has been able to do. Tesla has not been able to do that. So I can't argue with that, but I definitely would not pull them out of the Magnificent Seven. They can definitely turn it around as well. Now, obviously, if we're talking about stock price, obviously Tesla trading at a multiple well up over 200 is way out of whack with the rest of them there. So it's clearly trading way above its weight there. For a variety of reasons. That's just kind of what Tesla does, right? It goes from way overvalued to way undervalued. It just kind of swings wildly back and forth. But can they bring performance in to catch up to that valuation? Yes, they absolutely can, but it's not going to be a quick process, guys. This thing is going to take time. And you got to understand that on a high level. More importantly, how these sort of things play out, what sort of timelines you can realistically do, what to ignore, and what to basically take to heart whenever you're listening to a Tesla earnings call, for example, or you're looking through a lot of those projects like Robotaxi, like Optimus, a lot of those sort of things of that nature. All the hype birds are out there hyping everything to the moon. You got to understand the actual truth. That's how you avoid the disaster that everybody fell into in 2021. And instead, you're scooping up shares of Tesla, right around $100 or so on kind of rinse repeat here the past few years. Which, if you want to learn that, remember the Cyber Week sale ends this weekend, where you get the lowest price it's going to be because it's going up next year, where you get that. We do all that through direct access to me, right? You get free courses. We got free coaching in there. We got the best 6, 7, and 8-figure Discord out there, members helping you become a better investor. If you're willing to put in the work and learn, we are absolutely willing to take your investing to that next level. Make sure you check out the pinned comment down there. Take advantage before the sale ends. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. Thanks for watching, and we'll see you in the next one.